Hey, I'm Jonathan Wild, and we are going to cover how to record sales with returns and allowances. In accounting for sales returns, we record two entries, one to reduce revenue and the other to reduce cost of goods sold. So assume a customer returns merchandise that's sold for $60 and costs the seller $36. To reduce revenue for the return, the seller debits sales returns and allowances for $60 and credits cash for $60. The seller debits sales returns and allowances because it is a contra revenue account to sales. This means that sales returns and allowances reduces the amount of sales or revenue reported on the seller's income statement. The seller credits and reduces cash for $60 because they had to refund the customer. Continuing that example, the seller also has to record an entry to reduce cost of goods sold. Assuming the goods returned to the seller aren't defective, the seller debits merchandise inventory for $36 and credits cost of goods sold for $36. It is $36 because this is the cost of the return goods for the seller. The seller debits and increases inventory because the return goods go back to inventory. We credit and reduce cost of goods sold because the goods are no longer sold because they were returned. So now let's talk about sales allowances. An allowance is a price reduction given by the seller to the buyer. So this is like if we have a store and sell a new jacket. When the customer tries it on at home, they notice a zipper is broken. They are not happy. So we offer them an allowance or price reduction to keep the jacket instead of returning it. We avoid a full refund and the buyer gets a price reduction. In accounting for sales allowances, the seller records one entry to reduce revenue. So assuming the seller gives a price reduction or allowance of $40, the seller records the allowance with a debit to sales returns and allowances for $40 and a credit to accounts receivable for $40. The seller debits sales returns and allowances because it reduces the amount of sales reported on the seller's income statement. The seller credits and decreases accounts receivable because the buyer owes them less money because of the price reduction. If the allowance or price reduction is given in cash, we credit cash instead of accounts receivable. Also, if you notice, the seller does not record a decrease to cost of goods sold like they do with returns. This is because the good was not returned and the sale was not fully refunded.